For clients of ARC and Ledger Accounting, the baseline rule is absolute. If you are a U.S. citizen or a qualifying resident alien, you are subject to U.S. income tax on your worldwide income. Relocating to a foreign country or accepting an overseas contract does not sever your obligations to the IRS. Because the tax code prioritizes citizenship and legal residency over physical geography, knowing exactly how the IRS defines a tax resident is the mandatory first step for anyone working internationally. This table outlines the 2024 filing thresholds. The gross income requirements remain identical whether you live in California or Copenhagen: $14,600 for single filers and $29,200 for married couples filing jointly. The IRS definition of gross income includes all global earnings, even the foreign income you intend to exclude from taxation later on your return. For non-citizens, tax liability begins with the definition of a resident alien. The most direct criteria is the green card test. If you hold a lawful permanent resident visa at any single point during the calendar year, you meet the test and are subject to full U.S. worldwide taxation. Maintaining standard legal ties to the U.S. guarantees standard U.S. tax burdens, regardless of how much time is actually spent within U.S. borders. If you do not have a green card, the IRS uses a strict mathematical formula called the substantial presence test to determine if your frequent visits trigger tax residency. This timeline visualizes the equation. To meet the test, you must be physically present in the U.S. for at least 31 days in the current year and accumulate a weighted total of 183 days over a 3-year period. If you spend 120 days in the U.S. for 3 consecutive years, you count the full 120 days for the current year, 1/3 for last year, which is 40, and 1/6 for 2 years ago, which is 20. That equals 180 total days, keeping you just under the residency threshold. Without careful tracking, unmonitored business trips or extended vacations can push that number past 183, unintentionally triggering full global U.S. tax residency. While reporting your worldwide income is mandatory, the tax code includes specific mechanisms designed to prevent double taxation. As an initial measure of administrative relief, taxpayers living and working outside the U.S. and Puerto Rico receive an automatic 2-month filing extension, shifting the standard April deadline to June 15th. To directly reduce the tax burden on your global income, you can utilize the foreign earned income exclusion. For 2024, the maximum excludable amount adjusts to $126,500. This exclusion is not applied automatically. You must meticulously file your return and report your global income to legally claim this relief. Ultimately, your tax obligations are defined by the intersection of your legal status and your physical location. If you need strategic help navigating the substantial presence test or maximizing foreign exclusions, contact the ARC and Ledger accounting team in Culver City today.